On behalf of the University of Adelaide's MBA program, I warmly welcome all of you to our Uni Breakfast event at the National Wine Centre this morning. For those who don't know me, my name's Damien Scanlon. I'm the Director of the Adelaide MBA. Thank you to the staff here and our university staff who've made such a great effort to have us fed well, and it's a pleasure and great to see you all here. Firstly, I'd like to acknowledge that the land we meet on today is the traditional lands of the Kaurna people, and I pay my respect to their spiritual relationship to this country. I also acknowledge the Honourable Michael O'Brien MP, Minister for Finance, Police, Correctional Services, Emergency Services, Road Safety for the South Australian Government, and significantly an Adelaide MBA graduate. I'd also like to acknowledge Associate Professor Barry Bergen and all our staff from the Business School. Today we are pleased to welcome our special guest, Dr Guy Debelle, the Reserve Bank's Assistant Governor for Financial Markets and also a proud University Adelaide alumnus. Our event today will help us all gain a better understanding of the appreciation of the way the RBA influences and supports the Australian economy and business through financial markets. An understanding of how the value of the Australian dollar interacts, influences and impacts upon the fundamentals of the business environment is vital for our graduates and for the wider business community. We are delighted to have Guy along to the first of our 2013 of these successful Uni Breakfast events that are quickly becoming an important fixture on the calendar of South Australian business and academic communities. Guy will discuss the latest influences on the dollar, the effect of the exchange rate on the economy, and what the RBA does each day in the foreign exchange market. Importantly, we look forward to hearing Guy's insight into why, right at this moment, in our country's history, the Australian dollar is so high and what the impact is on our economy. Dr Debelle will also explain how the RBA sets the daily cash rate, the latest targets of the monetary policy set by the RBA board, and how this flows through to borrowing rates and mortgage rates. At its simplest, this is the nature of a floating dollar and a shifting exchange rate, and it seems right now that we are in one of the longest running periods of strength in our national currency that we have seen. I look forward to hearing from Guy on why this is happening and what the future looks like. I'd like to extend my personal thanks to Guy for taking part in today's events. A question and answer opportunity will follow Dr Debelle's presentation, so please feel free to raise any questions following his presentation.
I'm very pleased to be back in my hometown today. As Damien said, I'm a graduate of Adelaide Uni from the Economics Department. So what I'm going to do today is to talk to you about the Reserve Bank's dealings in financial markets. So why might you actually be interested in that topic? I assume most of you have a mortgage, or sorry, some of you have a mortgage, and some of you, those who don't have a mortgage, I at least assume probably have a deposit. So what we do in financial markets each day affects the rate that you pay on your mortgage or that you get on your deposit. So I'm going to talk a bit about how what we do affects the rate you get on that. And as Damien said, also I'm going to talk a bit about the exchange rate and what we do around the exchange rate, what we, the Reserve Bank, do around the exchange rate and some of the factors which are driving the exchange rate at the moment. So let me start with what we actually do in terms of implementing the board's monetary policy. So I'll start with how we set the cash rate. So as you all know, on the first Tuesday of each month, except January, we get January off, the Board of the Reserve Bank meets to determine the appropriate stance of monetary policy in Australia. So at 2:30 p.m, just after the conclusion of the board meeting, the Governor issues a press release announcing the board's decision, along with an explanation for the decision that the board took. And that decision takes the form of a target for the cash rate. And it's a job of part of my area, Financial Markets Group, to actually ensure that when the board says this is what the cash rate shall be, that it is what it is. So how do we actually go about doing this? I'm going to try and not make this too esoteric so I can get on to how it actually affects the rates you pay, but I think it provides you a bit of context for what we're actually doing. So the cash rate is interest rate on overnight borrowing in the interbank market. So it's, if I'm a bank and I want to borrow from another bank, it's how much I have to pay to borrow overnight, just one day. So it's just the rate, interest rate the banks charge each other to borrow and lend overnight. The Reserve Bank's ability to affect this interest rate comes from the fact that we control completely the amount of funds or liquidity in this market. So banks have to hold deposit accounts with us at the Reserve Bank called exchange settlement accounts. And these are the accounts that basically underpin the whole plumbing of the financial system in Australia. So when you pay your electricity bill, say, by direct debit, the funds are effectively transferred from your bank account across the exchange settlement account with us of your bank to that of your electricity company's bank and into the electricity company's account. So all the payment flows that you make every day in the economy go through these exchange settlement accounts each day. So very large number of transactions are settled each day. These exchange settlement accounts that the banks have to hold with us must always have positive balances. So we don't let the banks go into overdraft with us. At the end of each day, the balance in these accounts are paid an interest rate of 25 basis points, which is 1/4%, below the cash rate. So the banks have to hold this money with us and they get paid 25 basis points below the cash rate. If a bank finds that its projected balance looks like it's going below zero, it has to borrow from us overnight at an interest rate of 25 points above the cash rate. So they have to pay a penalty rate to do that. So given that they have to pay a penalty rate to do that, they don't want to do that, they have a strong incentive to manage their liquidity so they have just enough funds in those accounts, but not too much. So during the course of the day, if they think they're going to have too much funds, then they try and lend it to one of the other banks at the cash rate. If they think they're going to not have enough funds, then they try and borrow it from another bank at the cash rate, to avoid either leaving too much money getting paid too little or having to borrow at too expensive a price. So how do we come into that? Because so far I've just talked about how a bank borrows from another bank. So how we control this market is that we determine the total amount of funds in the market. We have complete control of the supply. So the demand comes from all the banks having to hold their accounts. The supply comes from us and only us. And it's the interaction of this supply and demand each day which determines the cash rate. So if in aggregate the banking system wants to hold more balances with us, then we increase the supply to stop the cash rate from moving up as the banks bid more aggressively to borrow from each other. If they want to hold less, we decrease the supply, otherwise banks would start trying to lend to each other below the cash rate to offload their excess funds. So it's very much a simple issue of demand and supply, except in this instance we are the only supplier.
It seems odd to me that both Switzerland and Canada are now going through a housing boom. Are we looking for another bubble that's going to crash, similar to what happened in the States?
In those two countries?
Yes.
Well, they're very worried about it. They're hoping or certainly hoping that it's not going to happen, but at least at the moment they're reasonably confident that it's not going to happen. The Swiss case is actually interesting because if you think, as I said, there was a large amount of people taking their money out of Europe and putting it into Switzerland. Now, one of the ways they did that was actually taking cash and buying, Swiss houses, basically, as a way to store their cash. So it's not, the Swiss story is not necessarily a credit-fueled one like the US. Yep. It's just a large amount of money moving into Switzerland. The Canadian story is much more a lot of lending, large house price boom. I mean, the Canadian economy's experienced similar developments to Australia in the sense, obviously, they've got a lot of minerals which are earning them a lot of money at the moment. So that's supporting that rise in house prices. But there is a reasonable amount of concern in Canada, including at the Bank of Canada, about developments in the housing market there.
We'll think about that in 2040. So if you any questions, please put your hand up and say who you are and where you're from.
Cowed everyone into submission.
Okay, we've got one over there.
Thanks, Guy. Ruben Broadfoot from the Commonwealth Bank. Just a quick question on intervention. Obviously, Glenn commented on Friday that the Aussie is higher than where the RBA expected it would be at the moment. At what level would you look to intervene in the currency market? And if so, how long could you sustain intervening to keep the currency lower?
So I'm not going to answer the first question at what level. Probably a bit higher than today. So that's because we haven't obviously thus far. But I mean that will depend on the context, I suppose. In terms of the second question, which is easier to answer, So one mistaken view that people often have is that we have limited firepower to intervene in the currency market. Now that's true if the currency is falling. It's not true if the currency is rising. So to cap, and the Swiss a good example of that. There's no limit on our ability to supply Australian dollars. We can do that till the cows come home. We have more Australian dollars than anyone else in the world, because we print them. So, so unlike on the other side of the story, when the currency's falling, we only, I said we have $36 billion worth of foreign exchange reserves. That's all we have. So if the currency's falling and we're selling those, there's a limit to that. When the currency's rising, and if you're intervening to cap a rising currency, you have more than anyone else has. And as the Swiss, a very clear example of that at the moment. Just to put the Swiss in comparison, so the Swiss economy, the Swiss have around about $500 billion in foreign exchange reserves today. If Switzerland's a smaller economy than Australia is, if you translate into how much that would be, if we were going down the Swiss line, we'd be having over about $1 trillion in foreign exchange reserves. We currently have 36 billion, we'd have $1 trillion in foreign exchange reserves. So that gives you some idea about the size of the intervention that the Swiss have done over the last couple of years.
David?
David Saint, University of Adelaide. I'm not an economist, which will become obvious when I say this question. I was watching a program on TV about the philosophical divide between Keynes and Hayek.
Yep.
And if I understand it, the world's gone very Keynesian. But Hayek says that the reason that we get these boom and bust cycles is because governments really don't understand the system. It's too complicated, and they'd be better off if they didn't fiddle with it and just went and sat on the beach. Has anyone ever actually tried that, or is that just too big a...
I'm all in favour of sitting on the beach, but so arguably, I mean, that's a difficult question to answer in a couple of minutes, but arguably the US was very Hayekian before 2007. There was the government, and this is a contentious point, but the government arguably got right out of the way and let markets do their stuff, and we've seen what happens. Also, the words Keynesian and Hayekian are often used as, don't necessarily actually represent the views of Keynes and Hayek, but and taken often sort of used as straw men. But I think, as I said, the period up to 2007 in the US in particular, at least, was broadly a period of unfettered markets. Now there were various, arguably there were some government policy actions which contributed as well, but that was certainly an area where, completely deregulated financial markets did their stuff, and so the consequences weren't all that pretty. So that probably wasn't a good advertisement for that policy approach. A different variant of that argument, though, is that these countries which are pursuing these very expansionary monetary policies at the moment should just basically suck it up and and just deal with they have to go through a very painful adjustment. They shouldn't just try to keep on postponing that. I mean, that's a harder question to address. And coming to the point Damien was talking about at the beginning, a lot of the reason why policymakers are doing what they're doing is because they looked at the experience of the Great Depression, and the conclusion they took from that is policymakers didn't do enough, and they could have prevented 30-40% unemployment by adopting more expansionary policies, and that the social costs of going through another Great Depression are just not worth enduring. Now that's a difficult question to answer as to where exactly that balance is. Clearly there needs to be some sort of painful adjustment. The question is how much and how fast.
Melville from Maddens. I'm not an economist either. I've just got a question that probably relates to the last couple of points that have been made. With the Swiss situation, where they're holding large amounts of foreign currency, I can see the advantages in that they can intervene to prevent their currency falling very rapidly in the future if need be. And also they've been able to, I suppose, arrest the increase in the value of their currency. Presumably there are some downsides. Would you be able to talk to those a little bit, please?
So the Swiss, when they imposed a ceiling on their exchange rate in 2011, already had deflation. So their prices were already falling, and the economy was basically in recession, and they already had interest rates at zero. If they'd let their currency go even higher, then they would have faced even worse, potentially quite damaging deflation. As it turns out today, even with them having capped their currency where it is, they still have deflation, although their economy is at least growing. The downsides are, one, you have to work out where you're going to invest those foreign exchange reserves, right? And so if you look around the world and you decide, where am I going to place those reserves? Do I, they obviously, you can't hold foreign reserves in your own currency. That's self-defeating, so that's out. So, which countries are they confident about investing in? And that's obviously an issue. So it's a large portfolio to manage. If you think about managing $1 trillion, there's only so many things you can buy with that. So that's difficult. There is, if they're ultimately successful, they don't have to worry about they don't have to worry about the value of that going down in their own currency terms. I don't think the Swiss are actually that worried about the Swiss franc falling very fast, very soon. In fact, they'd actually quite welcome it falling a fair way from where it is at the moment. So they're not holding the reserves in case the Swiss franc falls at some point in the future. They're purely holding them to cap the rise in their currency. And I think they'd be quite happy to see them gradually run down those reserves over the years ahead as the pressures on the Swiss franc back off. But I mean, the costs are really, the costs are really that you have to manage that large portfolio if ultimately you're unsuccessful. And in the end, maybe there's no great reason why you should be unsuccessful because you can always keep on printing more of your own currency. But if you are, then you potentially suffer very large valuation loss on those foreign currency reserves. And also, the larger they get, you have to be concerned about the sort of credit risks that you're taking with those investments.
Let's go over here, John.
Hi, Sarah Martin from The Australian. Just back to your first question, the first question on intervention. Could you just give us an indication as to what sort of confluence of circumstances would need to be present in the economy for the Reserve Bank to intervene and put a cap on the currency or any other sort of measures that might be considered?
I don't particularly want to go too far down that route right now. As I said, probably higher than where we are now. As I said, I mean, just coming back to the answer I gave to Tom's question, if you look at when the Swiss did what they did, they were facing deflation and a contracting economy, and with interest rates already at zero. So, and as I finished in my talk today, we still have some capacity to lower rates further should the need arise, and if the exchange rate is having, still it continues to have a contractionary effect on the economy, we still have some scope to offset that with regular conventional monetary policy. So that's not exhausted at this point.
Thank you. Chris Russell from The Advertiser. And sorry, don't want the media to dominate the questions, but given China is Australia's major trading partner, both for imports and exports, why does the Reserve Bank not hold much in renminbi? And is it something that you might do in future as the Chinese themselves are trying to get their currency to be an international trading currency?
I think that's conceivable, yes. The reason why is actually, even if you wanted to, up until very recently, you couldn't. So that's the very simple reason as to why not now, was that the Chinese didn't allow you to do it. That's only changed really in the last year or two. So can I think of that happening at some point in the future? Yeah, definitely. But as I said, up until now, it's basically been impossible. Only very recently have they even made it at all possible.
Any more questions? Happy to take more press questions.
I'm not.
Simon Lang from Simon Lang Wines. Just a question really that's a little different from the others that have been put to you. I was interested in the chance you would feel of the euro perhaps breaking up at some point in the future, firstly, and perhaps whether you think it even ought to continue on, or perhaps should, in what guise, and whether there'd be any need for, or what sorts of changes would be required to maintain that currency as a viable one.
Yeah, that's a great question. So as it turns out, so breaking up a currency is extremely difficult. It hasn't happened much in history. So as it turns out, when I was at graduate school, I was a research assistant for Rudy Dornbush. Now, those of you who did macroeconomics probably hopefully learnt from Dornbush and Fisher, so that was, they were my two thesis advisors. But I did a project with Rudy looking at the breakup of the Austro-Hungarian Empire, which ironically includes a very number of similar countries to those who are in the euro today. So that broke up just after the First World War, at the end of the Habsburg Empire. It was a lot easier to break up a currency, and so the Austro-Hungarian Empire had one currency, and then the empire fell apart and split up into a bunch of countries like Czechoslovakia, Hungary, Austria, obviously, and what was then Yugoslavia. That was pretty difficult to do even in those days, and what they did was they just sealed the borders and they stamped the notes. So if you're in Czechoslovakia, they stamped the notes, this is a Czech note, you can't, we won't accept any notes from Austria. But in those days there weren't anything, we didn't have electronic payments, for instance. So if you think about it, just the sheer nuts and bolts of trying to do that today, you think about everything which is literally hardwired into systems in Europe, incredibly difficult to actually try and do that. Obviously in the end, if you have the political will, maybe you can, but if you think about the logistics, extremely difficult. That's forgetting about whether economically or politically it makes sense. Actually, the logistics of trying to do it would be extremely difficult. And it took them a number of years of preparation to get the euro together, back a bit over 20 years ago, to actually get the thing off, 10 years ago, sorry, to get the thing off the ground. So, and that was actually preparing to move to a common currency. To break it apart, I think, would be incredibly difficult. There was a large discussion prior to the euro starting as to whether this was a sensible thing or not. With a lot of particularly US academics saying maybe this isn't such a good idea, and then the Europeans saying, well, it's all part of the euro project. And I think that's one thing to remember, is that the euro is not just an economic beast, it's actually a political beast. And it's part of one Europe. And so the political will is extremely strong, and European policymakers continually say today, don't underestimate the strength of the political will in Europe to keep Europe together, obviously given the experience of the past 100+ years. So ultimately I think that's the glue which holds things together, regardless of whether from a straight economic consideration it makes sense or not.
Well, having said that, is there a capacity within the financial system to actually forgive debt with some of those countries inside the...
Well, that's happened with Greece. So Greece has already had some debt write-downs, and some buybacks where they haven't paid, so you haven't got 100 cents in the euro back. Right. So that can happen, or it did happen. But
only with that country. There are other countries that are teetering.
Well, the negotiations at the moment are around Cyprus, which is obviously incredibly small in the context of Europe. But so far it's been Greece, and then at the moment they're working on, now that the Cyprus elections are just out of the way, and working on a support package for Cyprus.
All right. Got a question over there?
Rebecca Bryce from ABC Radio Current Affairs. Just in relation to Europe, what do you think the uncertain Italian election result, what do you think the impact of that will be on the European economy, the world economy, and Australia as well?
It's still in a state of flux at the moment. Uncertainty is generally not good, but I mean, I don't know. I think it depends on the outcome. I mean, in terms of... so let me answer the question a slightly different way. So if it's... From Australia's point of view, if Europe growth is a bit softer, that's actually not that big a deal for us. You know, they're not a particularly large trading partner for Australia. Obviously, we'd be much happier if Europe was growing stronger. That would be great. But the direct economic effects of Europe being a bit softer actually aren't that large for Australia. That said, and what the experience of the last couple of years shows is that when tensions flare in Europe, which sort of panics financial markets and panics people more generally, that's just not good for the global economy. So if that can be avoided, that would be a good thing. But if you know, said from Australia's point of view at least, or very sort of selfish point of view, Europe being a bit softer is not such a big deal. What matters is whether it sort of is much more the confidence effects both in financial markets and in the economy more generally.